Hello and welcome to the Harwood Report for October 22nd, 2018, presented by Trade Academy. I am Keith Harwood, the host of the Harwood Report and the founder of Trade Academy. Let's review the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Let me give you a couple moments to read through this because the lawyers want me to make sure you guys understand all of it. All right. We're going to talk about the markets, but man, what are they doing right now? It seems like we've got an overhang of a lot of things that are causing people to be worried, but they're not actually problems yet. So what do I mean by that? Italy, we're trying to deal out the budget. They've gotten their ratings downgrades and things, but it's not a collapse yet. And actually, that seems to have gotten a little bit better overnight, and then the market faded it. The China trade stuff, there's no real change going on there, but it's in the background. Saudi Arabia, it's in the background. Interest rates rising, it's in the background. Earnings coming up. Could they be bad? I mean, it's all in the background. It's all fear-driven rather than reality-driven right now to me. So yes, there is some reality to these situations, but there is some fear and concern that something could get worse that is driving the direction of these markets. So how do we trade them? Well, first, I think we want to look at that fear, and that's the fear and greed metric here. Basically, everything is showing fear except for this metric that I've stated a number of times doesn't matter. Junk bonds versus investment grade yield. If there was no greed there in January, this tells me that, okay, so there was somehow this was an indication that there was some fear in the markets if the levels were up there, and then as it's driven lower, it's gotten greedy. That doesn't make a lot of sense to me. It just doesn't seem to have a huge correlation to the market. It's not like it's had the same reaction as the market did, falling and spiking every time the market gets a dip. It's just there. So let's ignore that. Volatility's high, but you look at days like today and we're just not going very far, so maybe that can help pull that number down. This is an interesting sign. Lots of new 52-week lows coming in. A lot of these energy names and stuff are getting hit. A lot of biotechs are getting hit. It's almost the exact opposite of what happened in January. You saw how excited people were getting and putting every stock to a new 52-week high. That's how extreme the oversold conditions look right now to me. So that's something to be aware of as a potential bottoming action, not a bearish indicator, because you see how extreme they get, and that drove a flip. Bonds and stocks, whatever. The put-call ratio is at an extreme level as well. So you just see a lot of these extremes. People are getting their hedges on. They're selling losers. They're creating a scenario that looks almost like it would if we were in an extreme bear market, and yet, where are we? We're here. We're basically, at the end of the year, we closed at plus or minus 267, so we're up 3%, 4% on the year, sitting just below the 200-day moving average, creating a bit of a wedge here where the 10-day moving average has been resistance and support was kind of right around the 200-day moving average, but we've gone a little up and down around it, so it's not a clear support right now. The thing is, if we can get back above the 10-day moving average, we could start to see a spike. Where could we see that spike really? I got to think it's IWM. And why? Because IWM has been such a dog. So just to get back to the 200-day moving average, we could spike to 161. That is a 6% spike just to get us back to these key moving averages. There's just, I think, a lot of room to go, okay? That's what I'm getting at. That's why, in part, the VIX is still where it is. So with the market trading near the lows, people have a little bit of fear. But at the same point, even on the rally side, I think people are looking at this for a long haul play, thinking about the spike. What I'm expecting and sort of envisioning that means is a little bit of a grind for a few days, and then as the VIX finally starts to come down, that's when we can spike. So getting above the 10-day moving average is a little bit more of a grinding process, a couple of days. But then as we get through here and start pressing through, and now we've cleared the 200 and the 10-day moving averages in SPY and maintain our positions above the 200 and the 10 in the Qs. We can't seem to get that close above the 10-day moving average in the Qs. That could happen with the tech earnings this week, the Twitters and everything else that are coming out. So if all that starts to come through and we do a little grind higher, then the vol comes down and then we can spike. So how do you trade that? Well, you got to use complex options positions for a grind higher, or you just buy the stock and say, well, it's great, I made 1 or 2% in a week or two. I prefer doing the options analytics, obviously. That's why I do what I do. If I'm looking for vol to come down into a rally, naturally, my play would be more of a butterfly. You want the details on what kind of butterfly I'm talking about and how I set my price targets with that, you got to sign up for the premium newsletter. But just to give you guys a little bit of a sort of hint at it, the butterfly makes sense because then as you're rallying, you go towards your short strike, vol comes off, and you make a little bit of money on vol on Vega exposure. So that's how I'm looking for this market to behave on the upside. A lot of that fades if the Qs do close back below the 200-day moving average. So if all of the indices, the Qs, S&Ps, and small caps are all below the 200-day moving average, it's telling me that there's a real problem out there. But as long as there is something that people are willing to buy and the normal money flow for the market is in, investment flows tend to go in, I think we've got a bounce back maybe even to new all-time highs before the end of the year. But in the short term, I'm looking for moves back, sort of towards the lower end of the September range. Let's move to the bonds because they're doing nothing. So they collapsed and then they consolidated. And, like the 10-day moving average has an upward slope now. The MACD looks like maybe it should bounce. But yet, we got to fight through some of these moving averages if bonds are going to bounce. It means we got to get above the 20-day moving average. We haven't done that. We barely tried to outspace above the 10-day moving average. Are we really going to go much lower? It's not clear to me. If there's some fear out there, then people are going to start pricing in the fact that the Fed may slow down. So then you have a buyer. So if yields go higher, it almost creates a buyer because it creates a fear that the stock market may collapse. Now, if everything gets resolved with China, Saudi Arabia, Italy, etc., then maybe bond yields can start going up. But I don't think they have to necessarily go down because if they go down too much, then that just takes that risk off the table for the S&P. So it's sort of this balancing act where it kind of feels like they're going to go nowhere. Maybe the range is 113 to 118 now, though, instead of 116 to 121. So instead of that $5 range, we're setting up a little bit lower range with a higher yield. Volatility in bonds is not low enough for me to do anything crazy with this without a clear technical view. So I'm going to move to something that's getting a little bit more interesting and a little clearer for me, and that's gold. So you may notice here that we spiked because people are looking for an element that is not correlated necessarily to equities and helps protect. So a little risk off, all that good stuff. That's what we like to see gold do, except for the fact that we completely stalled at the 100-day moving average and dollar yen is firming and DXY is firming. So all the dollar elements of this are against gold continuing higher. And with that stall at the 100-day moving average and what looks like it may be the beginning of a rollover, I wouldn't be surprised to see us right back here into that 113 range. There's money to be made on that kind of move because the leverage has actually gotten a little bit cheaper in gold. People are starting to hit vol in gold. Let me show you that here. So in gold, it's not the height it was last week. It's now right kind of in the middle of its range. If we got down to 9.5 vol, that's a screaming buy on a Vega basis. Right here, realized volatility has been a little higher because of the spike that we've seen. I could see us just looking for a grind down. With a kind of maybe a spike down to 114 and then a grind down to 113. So I'll be looking at options structures and that. I put them out in the newsletter. They're interesting there. I'm going to give you some other kind of just updates here. GDXJ, I'm a little less interested in, and the reason is because of the way the volatility is structured there. So if we have the market recover, dollar continuing to be strong, gold falling, what do miners do? Do they go down with gold or do they go up with equities? Probably down with gold, but maybe not to the extreme level. And with this vol here near the recent highs, it's not a screamingly good play. Silver had lagged gold. It's probably got less downside, but downside nonetheless I think still exists there as well. Let's move to oil and oil names. So first we start with USO. We're getting some consolidation here. It's actually unchanged after looking like it wanted to break down today. Maybe it's going to use that 100-day moving average as support again as it did here. And, tested a little bit below here, but then here. So if this is all going to be support for us, we're going to bounce. We could go to new highs. That's got to bring back around XLE and OIH, doesn't it? And yet XLE is on the lows, and OIH is on the low lows. So OIH is back to September of 2017 levels, year ago levels. XLE, still quite a bit of performance there relative to September of 2017. So the exciting potential is in OIH. I think in the short term, the play is going to be on the short volatility side as opposed to long volatility side, playing for a bottoming action. And then as we start to get a little consolidation, I'm not necessarily certain we're going to see something like this, but if I see a candle that looks like that, a big hammer, where we kind of start below and then bounce back, I think we could be starting up for a multi-week rally here, especially obviously if oil rallies. If oil doesn't rally, then none of this works. But oil right now is starting to show those kind of candle, right? Where it had a, relatively flat open, but a lot of weakness overnight, a lot of weakness this morning, and now is going to finish close to unchanged. Creates some potential here. So this is something we got to be watching. Watching oil is a big one. I think we're a couple of days away from the big play there. In the meanwhile, short gold and silver might work, and there's some stuff happening now for rotating for a bounce in equities. You want to know more about how I'm actually looking at those positions, you got to sign up. And guess what? It's free for a week, so what's the risk? Might as well sign up for a week. Get that week for free. Find out more from the newsletter. You get another video on Wednesday with an intermediate update, which is what we're going to need because of what's going on in oil and equities. These midweek updates are that much more crucial when we've got a question mark about what's going on. And then after that, it's $49 a month if you decide to continue on. So take a look. Email me, keith@tradeacademy.co if you have any questions or concerns. And I will look forward to having you all on the service. Thanks again, folks. Have a wonderful afternoon.